So welcome to the last lecture of this course. This lecture 13 will deal with the sovereign debt issue in the European context, the implications for European integration, the implications of integration for the evolution of debt, the banking crisis, and of course the future of the common currency. Remember, the European Union doesn't use the euro completely in every country, so the fate of the euro is not necessarily the same thing as the fate of the EU, but they are quite linked since the most important economies are members of the European Monetary Union. So today I'm going to talk about the standard narrative which everyone should have in the back of their head, why this all happened. You can't just blame Greece, you just can't blame Germany, you shouldn't just blame the banks. It's a conflation of all these factors that made this financial crisis, this European version of the financial crisis, so unusual and so severe. But there is a standard narrative which I'd like to tell you, and you should remember that. But there are also alternatives which I would like you to pay attention to as well. The bottom line is that even though countries at the periphery of Europe are small, in terms of GDP, in terms of the size of their debt, there can be unintended effects of a small financial or sovereign debt crisis on the entire monetary union. And we need to understand why that's the case, the mechanisms that cause that to be the case. And it's obviously the integration of the financial sector across national boundaries in a system where national sovereignty is still an important issue in the regulation of the financial sector and the banks, leads to lots of tension. And that's one way of understanding why the European Monetary Union was not quite as well planned as it could have been. Okay, and this unintended effect, I mean, we always discover things after the fact. We could have done it better this way or that way. Hindsight is always better. Everyone knows what went wrong. But this was kind of an obvious point. And it makes you wonder why there must have been political reasons that these pretty much foreseeable events were not dealt with at the beginning of the monetary union. So once you're in this situation where a country has an explosive debt situation that can't be brought under control using the capital markets, one has to think hard about ways to bring this situation under control, because it can't, even a small country can lead to larger and larger problems. I mean, the volume of guarantees and loans that have been made to Greece, small country, 10 million people, 2% of the GDP of the EU, is pushing this new deal, should it be made, will be on the order of 500 billion, which is quite a bit of money. And it's just a loan. I mean, should be paid back, and it's just a credit or a credit arrangement. But still, for a small country like that, you can imagine that it has spillover effects, and that's exactly what makes this fiscal stabilization in a monetary union very important at the national or regional level. So we'll talk about some of the unfinished business in the European Monetary Union and part of the European integration project. Even for countries that are outside the monetary union, will have to deal with this. So Great Britain, United Kingdom is an important, very important partner in the European Union, decided to stay outside the monetary union. The same is true of Denmark. It's true of big chunks of Eastern Europe in the European Union. They still have to deal with the banking issue, even if they're using different currencies. Having common bank regulatory mechanisms, bailout mechanisms, common deposit insurance schemes are all very important issues. Monetary means money, it doesn't mean cash. Okay, so one of the big mistakes we made in the monetary union exercise was not thinking enough about the banks. Banks supply about 90% of the money supply in most modern economies, and it was kind of weird that we didn't think too hard about getting the banks right ex ante. So something to think about. But once you do that, you're getting into this issue of political sovereignty. We've heard from, in the recent Greece discussion, the Greeks claim that democracy and democratic rights have been flaunted Well, one has to describe what kind of democratic rights exist in a monetary union, and to what extent an electoral outcome has implications for the way other countries have to finance in a solidarity setting transfers. And this has never been discussed. This has never been discussed. In fact, in the European Treaty, it's explicitly ruled out. So I think the European Union needs to get back on the table and start discussing this in detail, because it's bound to come up again. And this issue of political sovereignty will be raised in the course of the lecture, which means the solution to this problem that we're observing now and the ones that are up on the horizon have to deal with sustainability. They have to has to be a solution that actually will last more than just 2 or 3 years, but one that lasts maybe 10 years or 2 or 3 decades. And this requires oversight, it requires governance. At the minimum, it requires exchange of information that's credible. So it means that the reporting agencies have to give the correct information to Brussels and to other countries in the Union, but also it might even mean more. It might mean that in cases like this, the Union has the right to impose fiscal discipline on its members. And this, of course, may be perceived as a violation of democratic rights. I think of Berlin often. Berlin is very similar to Greece. Berlin has about 80 billion plus in terms of debt, euros. This is I think it's actually 80% of GDP. So this is a potentially explosive situation. If the interest rate gets out of control, if somehow Berlin couldn't go to the capital markets with the backing of the federal government, this would be an issue. So it's something that's in our backyard. It's not just over there somewhere in Southern Europe. And then I'll review the course. So I guess you're lucky enough to have come today. I'll give you some tips on how to pass the exam, how to do well on the exam. So last week we talked about monetary policy and credibility. We talked about fiscal policies when monetary policy is not an option. We talked about government debt and debt dynamics. It's a very important equation we learned. You should look at those equations very carefully. They're very likely to be on the exam. Using those equations not just to find out the steady state level of the primary surplus that stabilizes the debt stock under a certain set of assumptions, but also what kind of dynamic is implied. So if the primary surplus is above that level, the debt to GDP ratio should be declining. So if you think about the Greece proposal, the proposal that was made to Greece 2 weeks ago was actually exactly that. It was a way of getting B over Y to fall in a fairly steady way over time, relying on a combination of domestic growth, low interest rates, and a primary current account surplus. Okay? So you can understand that. I mean, these technocrats in Brussels don't have a monopoly on cleverness. Okay? So, exam. Everyone looks up. Good. Stop playing games. Pay attention just for a second. There are 3 types of questions that the serial correlation in this exam is very high. So if you can get your hands on previous exams, that will help, but it won't guarantee you success because the questions will change. But the structure of the exam has reached sort of a steady state. So there'll be a true, false, and uncertain part. You have to explain if it's false or uncertain. Okay. There's a fill in the box with short answers. Might involve a short explanation of something, or maybe even a small diagram or a formula. And then you'll have a choice of essay questions. We're looking at 2 out of 3, possibly 1 out of 2. I'm not going to commit to 2 out of 3, but you'll have some choice. You have a chance of rejecting one of the questions you don't want to answer. Okay. So let's go to the standard narrative of the crisis, which you read in most newspapers, not in all newspapers. Some don't even get this right. This is kind of what most economists think happened. And I'm not talking about the North American, U.S. financial crisis of 2008 and 9. That had something to do with what happened in Europe in 2010 and 11. But one needs to focus on the European side because that's really what's most relevant for the reforms going forward, changing the governance system. So monetary union brought about many successes that no one gives it credit for. Remember, we talked about joining a monetary union as one way of getting your inflation down if you can't control yourself. And that adequately describes many Southern European countries. And in that sense, they did actually do a great job of getting inflation down. They didn't get it down perhaps enough to levels where there's not a deterioration of the relative terms of trade and the real exchange rate. We'll get to that in a second, but they did fall, no question about it. And they fell faster than in other countries around them. So there was a value of joining the euro in terms of gaining monetary credibility. As a result, interest rates fell, nominal interest rates fell, real interest rates fell. And if inflation doesn't fall as fast as it does in Northern Europe, then real interest rates are lower and have fallen faster in Southern Europe. Now we know from our macro classes when interest rates are low, people have an incentive to consume more, they have an incentive to invest more. And if that's the case, it's likely that countries will grow faster for demand reasons. Okay, so it's like a, think of it in terms of the AD curve. So either a combination of shifting out of the AD curve and moving down the AD curve, both imply increasing output. At the same time, you have this increasing trade integration, which means that everyone gets access to cheaper goods, but not everything is traded. So if a country in the South has a higher inflation rate than in France or Germany, it's because their non-traded goods are still rising faster than they are in the North. And you can see this in the data. Okay, and if any of you have visited, before the crisis, if you visited a country in question, for example, Italy, northern Italy, fairly wealthy region, or Barcelona or Athens, you notice that taking a taxi was much more expensive than it was in Berlin or in most other German cities. This has little to do with regulation. This is just a fact that there's more wealth and more real purchasing power in these countries as a result of this boom, and they were spending on restaurants and taxis just like they were spending on other goods that you can trade. So this implies a deterioration of the terms of competitiveness, meaning that wages rise in nominal terms to keep up both with traded and non-traded goods, and this leads to a loss of export competitiveness and increase in imports. And we see this in the data. Okay, this is documenting the steady convergence of inflation that occurred during the 2000 decade. You can see that there's still significant differences, and a 1 or 2% difference that's persistent over 5 years leads to a big change in the level of competitiveness, right? Think of P divided by P star, and if P is growing faster than P star by 1% per year, then in 5 years we have more than a 5% real appreciation, which means that it's more difficult to export your products. Why would it be the case that Greece actually imports olive oil, processed olive oil from Italy? Well, because Italy's possibly better business people, but maybe it's easier to invest in Italy than it is in Greece. But you'd think the olives are in Greece, and why are they being shipped to Italy to be processed and be sent back to Greece? So that's an indication of, why does Germany produce spaghetti? 10 years ago there was still some Teigwarenproduktion in Germany. this doesn't make any sense at all. And it has to do with sort of the macro relative competitiveness. At the same time, we have this convergence of interest rates. So the whole story goes through in terms of real interest rates being lower in the South. And of course, this is a really critical development that one has to view very, very very critically, there's no reason that interest rates in a monetary union where there lacks an unconditional collective responsibility for debt to have this type of situation. And what we see at the end, after 2008, is exactly an indication that markets are waking up or beginning to believe that indeed there is not an unconditional joint and collective responsibility for the debt that's issued by any particular member of the region. That's not the case in Germany. So if you look at the interest rates that are charged for Berlin's debt versus Schleswig-Holstein's debt versus Baden-Württemberg's debt, it's very, very similar. It's a few basis points difference. No one believes that the German government would ever let Berlin go, although there are people out there that probably would like to see that happen. It's not going to happen. This is not true in the United States. The United States state debt trades at very different interest rates because states can go bankrupt. They can go into default. So this is a graph or a figure that I took from the Frankfurter Allgemeine Zeitung in 2006. So this is before the crisis, 2 years before the American crisis and 4 years before the European version of this. You can see that already in 2006, this is part of a very interesting article that was written discussing the deterioration of competitiveness in Southern Europe. And you can see that all the countries that had trouble in 2010 are at the bottom of this graph. These are countries where the cumulative deterioration of the terms of the on the left-hand side you have sort of a measure of relative unit labor costs. On the right-hand side you have a relative price levels. Okay, and you can see that the cumulative deterioration since 1999, since the euro was instituted, is pretty negative. So this means basically chronic current account deficits for Spain, for Portugal, for Ireland. You know, Ireland had this big construction boom, which means people are feeling wealthy, their houses are more valuable, they spend more money, they import lots, they buy cars, they build more houses, German banks finance them. So this kind of thing can have some real economic benefit if Ireland and Spain are borrowing money to finance investment that will increase productive potential in the future. This is to be welcomed, actually, but we see a lot of consumption going on in the same period. Okay. Interestingly enough, real growth is correlated with that development. So those countries that had the biggest current account deficits were also growing the fastest. And we see Germany and Italy at the bottom. Italy for reasons related to the penetration of their markets by China and other newly industrializing countries, and Germany because of financing Eastern Germany and the Hartz reforms, which caused a lot of discomfort in the first few years. Okay, so you see that there's a real divergence, and this is something we don't want in a monetary union. So the standard narrative appeals to that. Okay, when you have a single currency, you have a one-size-fits-all. You can't necessarily tailor the monetary policy to a certain region because money is fungible, it can move around. All you can do is hope that the banking system, through its collateral requirements, might actually have a self-regulating mechanism. Regions that borrow a lot of money for capital projects can only put enough collateral on the line that they have. So banks that are lending in southern Spain, they have to always put up collateral to get refinancing from the European Central Bank. And but at some point the collateral just runs out. That's the hope. That would be a self-regulating, fairly weak self-regulating mechanism. Otherwise, all that can happen is that Spain in the south becomes more and more expensive, and then eventually this self-regulates. Spain goes back into surplus, and it's the Hume mechanism from way back when. Okay, Hume talked about this when he talked about gold flowing between export surplus and export deficit nations, and more of a hope that there will be an automatic regulator, a feedback mechanism through inflation. Gold, exporting surplus countries would get lots of gold inflow and would have more inflation, and that would sort of choke the process off at the at the root. Okay? But we didn't see that because when you have a common interest rate, there's no way that you can have that self-regulatory or self-regulating mechanism. I mean, theoretically, interest rates should have risen in Greece and Spain back in the early 2000s, and that would have slowed down those economies and possibly, and that increase in the interest rate would have been reflecting risk, not just a tightness of liquidity, but actually have been the market's correct assessment that this was not the place to push further loans to. But that didn't happen. When you have a common interest rate that we saw already, this is an invitation to throw money, and this is an invitation to German banks to throw money, and French banks to throw money at Southern Europe for all sorts of projects. And the economy was growing. You look at the people's paycheck. Oh, they're getting paid. They've got a solid job. So this is a classic invitation for trouble. So they could have done something to stop this. Clearly, the Southern European countries could have tightened fiscal policy. But you're having a party. Why should you take the punch away? This is the same thing that happened in Ireland. Things are going so well. They had a surplus, but they should have run even more of a surplus. So they should have really used active contractionary fiscal policy in good times to take the top off this party, because at some point it's going to lead to a huge hangover. Okay? But it's very politically difficult to do that. When the economy is growing and you see some people doing well, everybody wants to do well. You've got to increase welfare benefits. You've got to extend unemployment durations. You've got to do all sorts of things that make everybody happy, and no one saves for the rainy day. And then it happened. Okay, so this is the interesting thing. Well, no one really kind of got it back then that high capital mobility could lead to all sorts of ancillary problems, sort of problems that were coming through the cracks. And this is driven by financial institutions. And to some extent, it's what Mundell too talked about, Mundell number 2. Mundell's second argument for a monetary union, an optimal currency area, was that financial diversification could help us. So if a German bank bought a little bit of Spanish bonds, a little bit of French bonds, and put them in their portfolio and held it on their balance sheet, that would make it a less risky investment strategy than just holding all German debt, be it public or private, whatever. Okay, so naturally there was a lot of cross-border banking activity. Probably not enough mergers and acquisitions, because that would have helped a lot. Then banks would have paid more attention to the entire arena, but they paid more attention to their own arena. So the BNP didn't want to merge with a Dresdner bank, and well, we have UniCredit took over Bayerische Hypovereinsbank, whatever, both of those guys. And this was kind of it's happening, but it's happening at a very mixed speed. So ING took over some German direct banking. So we probably need more of that, because the banks have to somehow have a collective responsibility that the countries don't seem to be able to generate. Okay, but once you've got this national banking going across borders, you have risks, because the banks produce the money. We use bank accounts to pay for our goods and services. We don't use that much cash, no matter what your perception is. The fact is that the transactions in the economy are made using bank liabilities. And those bank liabilities don't have to be of German origin if you're in Germany, right? With a monetary union, I can use my French bank account if I had one. I could use that to pay for my bicycle that I bought in Belgium and drove to Germany. That's the whole magic of European integration. But once you have that, then banks have this incredible reach to other parts of the continent, and especially if they're lending and borrowing across national boundaries, makes things risky. It makes what I call ironically, the Achilles heel, to bring yet another Greek aspect into the story. This is the problem. Okay? So here's a picture I show to my Makro students occasionally. This is what we're taught In fact, the world is much more complicated, but you think of, there are households that are saving less than they're earning, they're consuming less than they're earning, therefore they're saving. You can also think of firms that are owned by households doing this. So anybody that's saving, anyone that's doing, any company that's running a surplus, an operating surplus, could be put in that category. On the other hand, you've got a lot of firms want to borrow, a lot of governments want to borrow, actually households. Some households want to borrow too. They want to buy a car on credit, want to buy a house. So this is just an abstract, sort of basic, And you've got to have someone mediating this. It doesn't even have to be such that the banks actually collect the savings. We know now the banks are much more sophisticated. They find a borrower first, and then they go refinance it with somebody else. So there's all sorts of, But in general, this is the idea. The financial sector is the hinge that connects both of these players, the borrowers and the lenders, be they whatever. And it doesn't look as simple as this. This is a hyper-aggregated, consolidated picture. And it's not just banks, by the way. It's investment banks. It could be shadow banks. It could be Sparkassen. Any sort of institution that does this type of monetary and financial intermediation. Okay? These guys do have a function, and we criticize them a lot. They also create the money supply. They do all sorts of things. They advise us on their investments, our retirement plans, insurance. So they have lots of functions. It's probably a problem because they have so many functions. One function where they really have us hostage is the banking system runs the money supply, right? So they manage the payment system. Banks clear against each other and enable us to pay for goods and services. So they really have us. And that's why the first financial crisis led to a problem. So in fact, it's not just a single bank, it's many banks. And these banks are also dealing with each other. Okay, so you've got this web of complexity that is impossible to even write down, let alone describe verbally, because these links are being broken and reestablished every hour. There's all sorts of complex contingent contracts that are being written, derivatives, let alone just cross-bank deposits. Sometimes these deposits are moved within a day. So this is an incredibly complex web of. So when the financial crisis hit, basically, it was a crisis of confidence that the banks among themselves couldn't rely on their counterparties to make good on their liabilities. And if that's the case, people get nervous. And then you have this contraction of intra-bank activity. And the interbank activity across European boundaries is exactly what we wanted in financial integration. But the first people you don't trust are the foreigners. I hate to say that, but that's probably what happened. Every national bank system tried to pull in its horns because it was kind of scared. Well, I know there's a problem in Belgium. Yeah, they've got this Dexia, or maybe the Italians, or those Germans, Commerzbank. Wow. So, I know that if I'm in France, my government's going to take care of me. It's a French bank, or Commerzbank will be protected by the German taxpayer. Okay, so the national boundaries sort of rear their ugly head, and we have something similar to what we had in 1913, right? And at the same time, basically, these banks are in trouble because the banks that were on the suspicious side were losing deposits. So not a bank run like you see on TV in Greece, but rather banks were withdrawing from each other very quietly, just transferring money out of their, or not renewing credit facilities. That's enough to cause the problem to occur. So these are huge, massive liabilities against large assets. And all you have to do is not renew the loan, and you're causing a contraction of credit. Okay? So the financial crisis, you can think about it as basically a drawing up of this trust and oil, if you like, in the system. Okay, so this hit Europe as well. It's not just an American problem, but the problem was really an American problem at the outset. Because the Americans had the worst initial conditions for this. Now, of course, the European banks had bought lots of American derivative products, and therefore, if the American system went down, the Europeans would have gone down too, right? The Deutsche Bank, and it's well known now that there are 4 or 5 banks that would have gone under had the Fed not taken over AIG and made good on its obligations. So, you know, thank you, USA. You could also say, sorry. It was a bad idea to bring these derivative products in such an uncontrolled fashion onto the market. But they were there, and they still are there, by the way, and they're better regulated and understood now. But as a result, in 2009, we had this problem in the United States and the world economy as well. And the financial sector was sick. You had to have bailouts. The government in the United States took a stake in the top 9 banks, all sorts of interesting actions, the TARP action. But this hit Europe in a very interesting way. The European initial shock was the shock wave, the tsunami of the drop of demand in the United States for real goods. But people didn't realize that the financial shock was just as important, which was that suddenly people were looking very carefully at all the debt they were holding. And this includes American pension funds that were investing in European securities. And for a long time, we're just believing Moody and S&P and Fitch that Greece was a solid A, if not double A. It took them until December 2009 to start changing their mind, which is outrageous. Okay, I'll tell you why in a second. Remember, Greece is not an important economy in terms of the size. Even Germany is only a third of the Eurozone GDP. And then you've got the EU, which is even bigger. So this is a small component. I mean, if they just went away, it would be terrible, but it would be a 1 or 2 or 3 or even a 20% drop of GDP in Greece is not going to put a big dent in the European business cycle. That's my suspicion. But financial integration makes it so relevant. Okay, so all this irrelevance on the real side is compensated by this incredible relevance. At the outset, you know, more than 100 billion euros of Greek sovereign debt was held by private or public banks outside of Greece. Okay, so the mere increase in the interest rates that I'm going to show you led to capital losses that should actually be marked to market and reported on the balance sheets, leading to very large losses, possibly insolvency for some banks. Think of Cyprus. Okay, Cyprus is very closely allied with Greece. They're like brothers. And it's not surprising that Cypriot banks invested heavily in Greek sovereign debt because everyone said it was A, and it paid well. Okay, so when you have an increase in interest rates, you have a potential contraction and potential spillover of risk. After the interventions by the ECB, 50 billion was held by the ECB. Okay. And the notion of just letting them go just doesn't work, because at that moment, we didn't know which banks were at risk. We knew that Commerzbank had some exposure. We knew that a lot of French banks had exposure to Greece. And if you think those guys are sick, then you're not going to deal with them either. So you had the spillover effect. And then people like you start taking your money out of Commerzbank. Well, hey, there's not be a problem with them. This is how bank runs start. Okay, so the bailout of the banks, as repugnant as it might be to some, was absolutely necessary to maintain the integrity of the financial system. I don't think there's any, you can be as libertarian as you want, but if you want to let the banks go down, you have to deal with depression-sized contraction. And you have to be willing to effectively to nationalize those banks. I think that could have been a solution if you really believe in libertarian principles. Ironically, the solution is to punish the bank by just nationalizing it and reselling it like they did in Sweden in 1990, 91. Okay, so you can see this was, you know, Hans van der Zinn, my friend, is fond of saying this was a French problem, but that's not true. It was also a German problem. German banks were also in the hock, or Greeks were in hock to German banks, and the Swiss as well. So this was kind of an international issue. And if you bail out the banks, you're helping your own, but also helping others. And it wasn't just Greece, okay? So we should be clear about this. All the southern European countries in trouble had exposure. And you see Germany's big Achilles heel was Spain. Okay, so these are quite large, numbers in 2010, 2011. And if you look at the, this is in German, but you can figure out what it means. Basically, the type of creditor is not just hedge funds, or obviously not at all. Mostly it's investment funds, so your parents' retirement or some private retirement plan, or private and public banks. So through the Landesbanken, your Sparkassen are involved. And of course, after the purchases, the central bank was up to here 30% of the total indebtedness. Okay, so this is just, again, for you to look at if you're interested. This shows you that there were a lot of banks involved. Commerzbank was at the top, but also HRE was involved, which I guess is no longer with us. This is a bad bank that consists of those bad loans, and they're being fed by the taxpayer for the foreseeable future. Now, how did this start? What I'm going to show you is pretty interesting, because it's going to show you the evolution of this crisis. In 2009, in the fall, Greece posted some numbers for their deficit. Originally 6%, and then they suddenly sort of corrected it to 13%. This is quite a large change. This is not within the realm of a simple cyclical adjustment. So this is quite a large change. This was after the elections. And rating agencies had not done any homework on this. There was no reporting on this at all, as far as I could find. And in the end, it was a pension fund, PIMCO, which to some extent belonged to Allianz for a long time. I think it still has some stake in it. And run by someone named Bill Gross, who called the Greeks finance ministry and asked, how can you do this? How can you go from 6.5 to 13 plus or 14%? And the answer was, well, we had a few adjustments, and it wasn't satisfactory. So instead of complaining, Gross just hung up and sold his entire portfolio of Greek debt. Now, PIMCO has about 1.3 billion, 1.3 billion under management. It's 1.3 trillion, actually. 1.3 trillion under management. That sounds more like, it's like, it reminds me of that show. The guy says, I'm going to hold you hostage. You pay me $1 million, and they'll laugh at him because he's coming from the time machine. 1 million is nothing. So it's 1.3 trillion under management. So he basically dumped his entire Greek portfolio. And when you do that, the market can't absorb it, so the interest rate rises. Suddenly people pay attention to Greek debt. So in the first week of December, you can actually see the yield on Greek debt starting to rise. By the end of the year, it had doubled, and by the end of the second year, it had doubled again. So the market's really voted, and you can say this is a frenzy, this is like a piranha feed, but in fact, it looks more like the emperor has no clothes, we better get out as quickly as we can. Somewhere in the middle has to be the truth. We'll talk about that in a second. So if you think about it, if B over Y is 115% in 2011, 10% of that is, if they had to finance the entire thing at 10%, which they don't because they have some older debt, but at the margin, that's a huge expense. That's 11.5% of GDP. That's not sustainable. Germany couldn't do that. Nobody can do that. Those interest rates are not sustainable. So you can imagine the nervousness of not just the investors, but also of the Greeks. So that's what it looks like. So you can see the first increase occurs at the end of 2011, 2009, like I said. And then you've got this big spike in 2010. And then when they started talking about private participation, it went up even farther because no one wants to lend money if the old rules don't apply anymore. The old rules seem to be countries can't go into bankruptcy. Okay, and that's kind of where I haven't extended this to the current situation. It's gone up again. But again, what happened as a result, the bailout meant that, and you have to really pay attention now, the bailout meant that the European Monetary Union's members, plus the ECB, plus the IMF, actually just assumed the debt that was coming due. So it took over the debt. That's what we call a bailout, because the Greeks could not have refinanced the debt coming due. So the Europeans took it over and at a concessionary interest rate, at a low interest rate. And now they're negotiating over the interest rate as a primary current account deal. Okay, so you can understand why it's so important to understand that equation. Okay, but this is an amazing, this is usually what you see when companies go into junk bond status. Okay, so we want to summarize what happened. The Greeks didn't tell the truth. They got low interest rates when they joined the euro, and like any good economic agent, they start spending money because their interest rates have fallen in real terms. German and French and other lenders were offering money to these guys. It wasn't just the Greeks. They were getting financing across the border. So obviously, if someone gives you a credit card, you've never seen one before, I'm going to take this, right? This is an interesting idea. And people can get into trouble. So it takes two to tango. Somebody had to lend that money to them. Okay? And Greece didn't grow. So Greece grew very fast before the euro. I'll show you in a second. And they were growing at 4%. And then when they joined the euro, this kind of put a damper on their growth, which made things even worse. And the German economy had surplus with these countries, which means they had to have deficits. So in a sense, the current account surplus of Germany with Greece was financed by private capital or public capital. Public capital here means central bank transfers, like the so-called target balances. Okay, but for the most part, off was close to zero until the financial crisis. So only after 2009 did the target balance for Greece versus Germany or Spain versus Germany go into surplus for the German side or deficit for the other guys. Okay, so this is the government surplus in the long horizon. This is a time series from, and this is in percent of GDP, the government surplus. So you can see the government deficit has always been negative, never gone into surplus, but that's okay. We know what matters for the debt to GDP ratio has more to do with the primary surplus. And it depends on the relationship of growth to the interest rate. And interest rates were falling in this period, so Greece didn't have to grow very much to keep its government debt constant. This is with an environment of falling inflation and interest rates. So if I look at, we'll show the picture in a second, Greece's debt to GDP ratio is actually pretty stable until 2010. And then it explodes. Despite the fact that they had a high level of debt, it was kind of a dangerous, it's like walking a tightrope between these two buildings. You can do it many, many times, but eventually you're going to fall. That's why you want to have a net underneath. So the lesson is you shouldn't do that. Okay, but for most of us, the most important thing is what happened afterwards. So after this financial debacle for the Greek sovereign happened, then basically other things started to happen. So there's collateral damage, public finance, meaning taxes and expenditures. Most importantly, thinking of the crisis coming from the United States, the drop of demand meant a slowdown in GDP, slowdown in tax revenue intake, and potentially public spending going up, like we fixed this building in Berlin in 2011 or 2010 because they wanted to spend the money to stimulate the economy. Right? So G goes up as an endogenous or policy response. This all implies larger budget deficits. So even despite the crisis, there was pressure in Greece to increase their deficit. They had to because their tax revenues were falling. That's the endogenous part, but there wasn't much room to do much on the spending side. So the Greek fiscal posture was probably contractionary after this shock. But what happens is that when you start doing this on a grand scale, the public debt of all the countries starts to deteriorate. So falling growth, you can see the Great Recession was great also in Europe. I mean, there's a sharp drop of output in 2009 and a slow recovery, except in the case of Greece for reasons we can understand now, right? This shows up in the deficits. So across the board, deficits get worse. And these are not corrected. These are gross deficits, including interest payment. So all those negative signs. Now look at Ireland. Ireland is fascinating. Ireland is a special case. Ireland had to bail out its entire banking system because it guaranteed the deposits of all the banks. It made a commitment. Publicly, the government made a commitment to do that. So between 2009 and 2010, it had to borrow a huge amount to bail out the banks at very punitive interest rates. Okay? So the financial crisis had this second round effect, which meant that public finances were hurt because banks were getting hurt. So the banks hurt the government debt hurt the banks, and the banks going bust hurt the government. So you end up having a situation like, the liabilities of these vis-a-vis the government start to rise in uncontrollable fashion. Some of them go bankrupt, and we end up having the government running up debt, assuming the debt of these bad financial institutions like HRE or Commerzbank or whatever. Commerzbank is still going. It's just a government stake. But these all have fiscal implications. I mean, the government's deficit has to somehow reflect that, and that's why those pictures show that terrible increase. Now, look at Greece. This is the upper figure is the gross government debt to GDP ratio, and you can see that it was pretty. I mean, the Greeks were, given their circumstances, given their growth rate, given the interest rate, they were able to keep the debt GDP ratio at 100% for something on the order of almost 15 years. Okay? Now think of the equation in your head, B over Y times R minus G equals the primary surplus. This is, if you see the primary government surplus, you can see that it was actually in surplus. So this is the second figure is the IMF's calculation of the government position surplus, taking taking out interest payments, or in the sense interest income. So if you do it the other way, you take the headline deficit, you subtract the interest payments, and that gives you the primary deficit, and you put a negative sign in front of that, and you get this picture. So between 1993 and 2003, 10 years long, the Greeks actually ran a primary current account surplus. So it is possible for them to do that. It's a combination of decent growth and low interest rates and a fairly manageable debt stock. If B over Y is 90%, it's easier to control than if it's 170%. Right? That formula is very useful for understanding. Now look at the red line. This is the sovereign debt crisis for Greece, and after that you can see they're moving into surplus. They were going into an uncontrollable debt spiral before that. Okay, so something had to happen. And if you look at the data, the Greeks have made amazing progress. Moving as they have over the past 6 years, it would be hard to expect the Germans to do that. Okay, the Germans did the Hartz reforms, but they didn't do this. This is real. This implies real short-term misery. Okay, and at the same time, debt is still rising as a fraction of GDP. Why? Because GDP is not growing. GDP is shrinking. Okay, so it's a the economy's base is shrinking, and we're very hopeful that it's not permanent. This is not a permanent. Part of that will be permanent because a lot of the lost output will be in sectors that will not come back. That's my suspicion, but not all of it. And it's not just Greece. So we can extend the story to all the other countries in the periphery and Ireland. they all have this sort of dangerous uptick in debt. So you can see that having the debt in a stochastic world is a source of risk, because a series of bad events can cause your debt stock to go get out of control for reasons that we understand from our equation we learned last week. And the most important lesson of the European sovereign crisis is that banking and fiscal issues are intertwined. They're sort of, they're not, I think that's intertwined. But whatever. So you have two classes of countries. One class of countries are the ones that had low interest rates, a demand boom, didn't restructure their economies, didn't adapt to the world situation, and ran deficits, government deficits, the whole time. Okay? Even Greece, we showed that Greece had a surplus, but it wasn't enough to get the debt stock down and to solve their other problems, the supply side of the economy. And then you have countries like Ireland and Spain where there was a real estate boom. So you were investing in productive capital, I guess. You can only build so many houses, but they built lots of houses in those countries. And the banks didn't do very good supervision at the margin, and this caused many of these little savings banks to fail. And then you had bailouts, and the government deficit of Spain was increased significantly. So Ireland and Spain both had that problem. And so it's really hard to distinguish between the two, especially when the banks have a commitment by the government to be bailed out if things get bad. So you can see that regulation, governance are very important issues. So this is from Handelsblatt showing you the change in government debt. And this is kind of showing the banks in relation to that. So this is, every country has their own little problem bank. Okay, it's not just the Italians, or not just I think it's really abhorrent that people keep putting this in national terms. You know, it's certainly not the case. I mean, Germany is just as much to blame as the others for lending in a way that is kind of irresponsible, not sort of asking the hard questions. And this dependency hasn't been eliminated yet, but there are lots of interesting discussions on how to deal with it. You know, one way to deal with it is to actually introduce an insolvency regime for countries, make it possible for a country to fail, so their debt is not 100% guaranteed by anybody else in the European Union or anybody else in the monetary union, or meaning the investors may have to take a haircut under certain conditions. Okay, so you know it's kind of disingenuous to blame austerity for everything, but clearly the sharp recession that occurred in Greece was because austerity was forced on Greece by the financial markets. I think the best way of thinking about this is this spike in interest rates made it clear to the Greek government they couldn't run these deficits anymore. So when you react to that, you have to cut government spending, raise taxes. This is before the Troika came. And of course, when the Troika came, they were enforcing a governmental loan that had taken the place of the bank loans. But had the bank loans not been replaced, Greece probably would have been insolvent. It probably would have been like Poland in 1993 or 2, wherever it was, when they had the restructuring. Okay. So I've told you the fundamental story. There's another story. The fundamental story is like the foreign exchange story. Fundamental factors cause a currency attack. The non-fundamental story is interesting, and you can't rule it out completely. You have to deal with it, because the financial markets, we know they are sometimes out of control. They do things that are just not, for example, the convergence of interest rates just doesn't make any sense. It happened, and it was done under the auspices of the financial markets. They did it, right? They can force these interest rates to converge the way they did. Supplement to the fundamental story is the non-fundamental story, which was that if you have a situation where you know that the country cannot in any way pay back the debt, then just the suspicion that they can't pay back makes it possible that a jump in interest rates will lead to default. So we talk about a self-fulfilling prophecy. The idea that Greek 20-year bonds jumped from 5 to 20% is enough to cause the default of Greece, even if Greece's fundamentals are okay, because there's just no way they can convince the markets that they're going to be able to do the heavy lifting. Okay, so you can imagine multiple equilibria. It's a multiple equilibrium story. And this is also a reason to pay attention to the financial markets, because maybe their excesses may cause problems for the rest of us. So we need supervision. We need some form of, at least some sort of governance on the level of exchange of information, and maybe doing lots of reports and criticizing developments in the real estate market, for example, or in other markets. In any case, we still got to get back to the issue at hand. If B over Y is out of control, you got to do something. So we have to go back to our equation and look at that. That's what we need to stop B over Y from growing. Because if B over Y grows without bound, then there's going to be either a hyperinflation or a crash default, uncontrolled default. So it's in every country's interest to pay attention to this equation, right? This is the steady state condition to prevent B over Y from changing or increasing. To keep it constant, you'd put an equality sign, an equal sign, in place of the weak inequality. Okay? So armed with this, we can actually ask the hard question: how do you stabilize B over Y? Well, you just have to do things to make that equation hold. So everything we've observed in Greece, in Brussels, the negotiations that have hopefully been successfully concluded, we'll see, involve some parts of this equation. It's all about making the primary government deficit fall in the range that means that you're actually making some headway on B over Y, not necessarily on B. If the growth rate is 0, then you really do need to have a surplus. But you can imagine a situation where the economy is growing so fast, as it did in the 1970s relative to real interest rates, that the economy can run deficits and still have a constant GDP ratio, debt to GDP ratio. But we don't have that situation anymore. G is very low, and R, for a country like this, would be rather high. Okay? So a primary surplus is important, and that's why the European Commission has been harping on this as part of the negotiation strategy. Primary surplus will give you a concessionary interest rate. Greece has 180% of their GDP in liabilities to the official lenders. That's a lot. So even if you charge them 1%, that's really concessionary rate, it's still a lot of money. Okay, and therefore you've got to think about the primary action on the primary surplus. Okay, so to do this, we can go through the different possibilities. It's pretty easy, right? You raise taxes, VAT, tax on apartments, make the rich people pay. These all have short-term contractionary effects. So Keynesian would immediately say, well, you're going to make things worse. You're going to reduce GDP in the short run. Probably. That's right. Reducing spending, and I'm talking about spending on goods and services, not transfers. That goes into the taxes. Net taxes is net of transfers, would also contribute. Okay, so cutting the military spending, spending less money on German tanks, for example, German submarines, French radar systems. Then you can sell off government assets. So this is a proposal that's wasn't just made recently. It's been made frequently. You can actually directly pay down B. If the government has some silver and they can sell it, they can take the proceeds and just pay down B, buy the debt back, or retire the debt. That's an option. Okay. This is being discussed right now. There's a discussion of a $50 billion Treuhand fund. Okay, which is, again, the valuation of those silver pieces of silver, or the family silver, is kind of a subjective thing because you need to have a serious privatization with serious international competition. And I think one reason that the European side was insisting on doing this in Luxembourg is keeping corruption out of it. I mean, everybody wants to have the Piraeus port, right? I'd like to have it too. But you want to have someone who pays the full market, some sort of market price for it. And the best way to do that is have an auction. And for some reason, the Frankfurt airport is trying to buy the Athens airport without an auction. I think that's kind of weird, isn't it? I mean, nothing against Frankfurt, but I mean, they already screwed Berlin in terms of our airport, so. It's an interesting point. You can reduce the interest rate. The interest rate is not necessarily a market rate. It's just it's the rate that the country has to pay. So if you're in Germany, Berlin has this great interest rate. It doesn't have to pay the Greek interest rate because there are enough people out there willing to lend. And therefore, the European partners, the European Monetary Union side of the Greece bailout negotiations can negotiate a lower interest rate. They can make it zero. Why not? That's the idea. Make it zero for 50 years or 40 years. And then after that, you can start paying interest. As long as the primary current account is positive, that will reduce B over Y very quickly. And of course, the hard part would be to raise the growth rate. You know, Greece is 25% below its trend. That's a depression in my book. That's the United States in 1935. It's East Germany in 1992. This is serious business. But again, we don't know if that trend is really real anymore, whether it's real potential. Maybe the potential has shrunk. Maybe there are lost opportunities. Greece will never achieve that trend path again. But still, you can do something about it. And of course, the last alternative is the one we don't want to talk about. Okay? It can either be a controlled default, which is what Schäuble was presenting. Schäuble's idea, his paper, a very controversial paper that focused ideas very quickly, focused the attention of the Greeks very quickly, or the uncontrolled variety, which is a disaster. It's a failed state situation where nothing gets paid, and you know the Russian Tsar's government still owes money to French people after 100 plus years. That'll probably never be paid back. And they're still negotiating. They still meet and talk about it, but all right. So, you know, how do we deal with that? Well, how do one approach is to do the classic sort of IMF program, and that's kind of what they're doing now. Now, I'm actually a bit skeptical that unless this is done with other stuff, it's going to work, because it never worked in the past. It didn't work when Churchill did it in England to get sterling back on the gold standard in the 20s, early 1920s. It didn't work. It didn't work when Brüning tried to do it before Adolf Hitler took over here. And the IMF constantly imposes this classic program, which means like just deflating or less inflation relative to your partners by doing fiscal discipline. Okay, so it may work. You may have to support it with some external assistance. So as I understand it, the current proposal on the table, the Germans have proposed, or the Europeans have proposed, spending about 70 billion of the Juncker plan in Greece. So this would be great. This is like an extra stimulus. Even though you're cutting the government spending side, you could be stimulating through this type of exogenous increase in spending on infrastructure, build up Greek infrastructure. Now, of course, this doesn't exclude the possibility that a bailout is also a part of the package. So you can think of just a pure bailout. That's what they did in the first and second programs. There was no commitment, a solid commitment to doing anything, and they didn't do anything. And the financing of that is up for grabs. I'm not endorsing euro bonds, but that's one way of doing it. One way would be to issue a new type of liability at the European level which would be collective liability. But it's not a very popular subject in this country. And then, of course, there's default, which sometimes is called soft default, which means, participation of the creditors. So in a sense, Greece did default in 2012. But if the rating agencies don't call it a default, I guess they didn't default. So, or if the derivative agency that is responsible for declaring these events didn't do it, then the credit event hasn't happened. But in any case, the fear is that it could get very nasty if you have an uncontrolled situation where there's an exit from the Eurozone. The Greek government has to print IOUs to pay its employees. This becomes a parallel currency. The currency is traded at a discount to the euro, and eventually, after 5 years, it's, hey, it looks okay, it works. But the people who were being paid in euros before and getting drachma now are probably getting a big cut in their pay or their pension or their benefits. Okay, so, a lot of the issues are involved with the short run, and I'm concerned about that, but Greece has had a lot of austerity already. I don't think they're getting any more austerity now than they would have gotten had they had no bailout. The correct counterfactual is the exercise. What would have happened had the Europeans not intervened in 2010, the first time? It would have been an IMF-managed default, and there would have been austerity anyway. It would have been sort of a self-imposed austerity because you would have had conditions imposed from the side, or you would have had your own currency and a big jump in the price level. Okay, so the long run is thing which you want to worry about is how to get countries back on some growth path. That to me is more interesting. It requires patience, and there are cases where it has worked. We have them now. I've been here for 25 years. I've seen it happen. There are countries where long-run supply-side reforms have actually caused the trend growth rate for some period and the level of output to rise. Germany is one of them, but also the Netherlands, and you can think of Denmark or to some extent Ireland. Okay, but you need to have perhaps a bit more exchange of ideas. Call that political cooperation. Not necessarily coordination of policies, but you could even talk about that if that's politically desirable. All right, so making Y grow is the question. How do you do that? Well, patience is one important thing, but you can talk about the markets where this matters. One is the product markets. One is the labor markets. Another point is competition policy, allowing more competition. More competition in the telecommunications sector in Germany helped in the 1990s to make your telephones cheap. And of course, you need to have a discipline, not necessarily austerity, but just to be able to control yourself in some way. Now, like I said, there are many instances where this has happened, but it takes a long time. So I wrote this slide. This slide goes back several years, but it's still true. I mean, once this package gets enacted, it's going to take 3 to 5 years for us to see benefits. And they're going to have to be patient enough politically to let that happen and convince people who do investing, people who actually build factories and invest money to be convinced that it makes sense to go there. Otherwise, it doesn't make sense and nothing will happen. I'm going to finish by talking about governance. Okay, so it's about governance. Europeans want to have their own government. They want to have sovereignty. They want to have democratic autonomy. But if you're going to have a common currency, if you're going to go the next step and have a political union, we now have a banking union. We're talking about a capital markets union. Some people are even talking about a fiscal union. And I think political union is just around the corner. These are all things that require a lot of discussion because people have different concepts of what they think is right and wrong, what is good and bad, what's the appropriate level of solidarity and fiscal involvement in the economy. And Europe is a big place. It's, it's geographically and politically big. So one thing they could do would be just to implement, if you want to have sovereignty, then you have to make sovereign states pay the price if they misbehave. So, Merkel says it's not just about solidarity, it's about responsibility. So if we'll have solidarity in the worst case. If you have an earthquake, we'll help you out, but we're not going to help you out on a permanent basis because you don't want to be part of a single country. That's fine. It's the way it is in Switzerland. Okay, it's the way it is in the United States to some extent, but the U.S. obviously has a more intrusive presence of the federal government in many different ways. So if you think of it, I took this from a talk given by Klaus Regling, who runs the European Stability Mechanism, European Stability Fund, and it's kind of his idea was that it's about strengthening governance with a view to a crisis mechanism. So how do you deal with crises? How do you deal with something that happens that we didn't anticipate? So we didn't anticipate Greece going so far south. We didn't anticipate the Spanish real estate market. We didn't anticipate German unification. So you need to have some response team approach where you can actually deal with this. One way to do that is to create a stronger banking system, a European banking system, which means that we have to deal with maybe giving away some of our acquis. The fact that Germans love the Sparkassen, or the French love the Caisse d'Épargne, and the Spaniards love the cajas, whatever they're called, may be a price that could be on the table. If it's a problem, I'm not sure it's a problem. But governance is an important issue. You have to be able to make sure that weak links in the regulatory mechanism don't lead to two types of arbitrage that lead, again, to crises. You need to have an active monetary policy, and I think that's clear. We haven't talked about it a whole lot, but I'll talk about it in a second, which is the role of the ECB. The ECB is one of the few truly European players in this game. The ECB is basically pulled it out of the fire in 2011 and has done it time and again in various ways. The commitment, just the verbal commitment to do whatever it takes to save the euro was enough to scare away a lot of hedge funds that were speculating against the future of the euro. Further steps we can talk about, I will talk about below. So look at what, let's be positive before we start, worrying. I mean, if you think about it, the crisis was bad, and Europeans had their own role to play in it, but things are getting better. So if you look at these pictures, you see fiscal balance is returning to some sort of normal. We don't have to have a balanced budget. We don't want to have a balanced budget. We want to have some flexibility to deal with fiscal issues if so desired. But we want to get B over Y under control. And this is the way to do it, given where we're coming from. The only other way to get rid of B over Y is to inflate it away in a surprise inflation. And remember, B over Y is the real debt stock divided by the real GDP. So to do that, to inflate away the debt, you really have to pull a fast one. You have to issue a lot of debt long term and then have a surprise inflation. You can only do that once every 50 years. Okay, so that's, this is the only way to stabilize in the right sense. On the right side, you see the fiscal balance. This is the total balance, not the primary. Okay, I'm going to speak briefly about supply side because it's one of my favorite topics. I think it's important. We don't pay enough attention to it because it's kind of boring. It's also kind of, it's like conceding that Hayek was right, that little guys actually can do a lot. The market finds the right way of dealing with things. We need lots of startups. We need lots of hiring and firing and young people who are dynamic. It's kind of, it's not necessarily Hayek, but it's the discovery process of the market that he talked about. So you need sustainable economic growth, and Europe has been growing slowly since the euro. There's no question about it. And there's a question of causation. Is it because of the euro, or is it concomitant with the euro, or is it just something completely different? And I think one of the things Europe needs to work on is the regulatory mode, the regulatory framework. And I showed this. I show this all the time. I show it again. It's a very important picture. The ease of doing business. This is an index that consists of ease of starting a business, ease of closing a business, getting credit, getting electricity, concluding contracts, executing contracts, going bankrupt, all these issues. And what you see is a composite rating. So you see there are a few European countries at the top, but most of them seem to be in Asia or in North America, maybe Australia. And the second 10, it looks a little bit better, but it's mostly Scandinavia, Nordic countries. And then you've got Germany, position 21, which is, the most important economy in Europe. That's kind of makes you wonder. There are some things that maybe could be improved. But I don't see France. I don't see Spain. You have to really go to the next layer. And it's just kind of embarrassing that Portugal and Rwanda are kind of on the same. And this is not a biased survey. This is done by the World Bank. If anything, the World Bank has no interest in, sticking out its tongue at important developing countries that help fund it. But you see Portugal and Rwanda and Chile. Okay, Chile, we know Chile is kind of like a little bit of a miracle. And there's France, number 38. Okay, so there's some improvement that needs to be done there. This is like a hall of shame thing, If you look at Spain, behind Tunisia, it makes you kind of wonder. Tunisia's got a lot of problems, but obviously doing business is not one of them. And then if you look further down, you can see Italy is 65. In 2011, it was number 87. So obviously there's a lot of pressure on these countries to do stuff. They have done stuff. Greece has moved from 100 in 2011 to 72 in 2013. But, the tendency is not always rising. And yet, depending on the political situation, this is where job creation comes from. If we want to get growth up again, you want to be more like Ireland and be less like Rwanda. So surprisingly, the reform countries have made progress. This is news to me. This is also from Regling's paper. The reform countries, the top reform countries are the countries in programs right now. Program country means they're under assistance with the ESM or the ESF, the bailout program. And here you have the same thing true of a different type of adjustment criteria, which includes the fiscal deficit and labor costs. Okay, so there's light on the end of the horizon. If Greece gets a chance, if they give themselves a chance, the country will turn around. There's very little question. The question is how long and how sustainable will that turnaround be? Okay, so this is again another summary of the improvement. Now again, you can doctor these obviously, because you can game these statistics a little bit because it's a large index. It's based on surveys of lawyers and financial accountants and consultants in these countries. So I'm not saying you can bribe these people to give the right answer, but you can certainly change the external, the facade, and not change the spirit. So you need to break down Greece's ranking into the component rankings and look how easy it is to start a business. And there they haven't made as much progress as they could. If you want this, I urge you to go to the World Bank's website. It's called doingbusiness.org. You can do it right now if you've got your computer on. And you can look up any country you want. You can make comparisons. You can get a complete ranking. You can download the data and do all sorts of fancy stuff with it. The data has been around for 10 plus years now. Okay, I talked about policy coordination. There are a lot of things you can do. We've talked about the Stability and Growth Pact. We've talked about trying to get governments, national governments, out of the way in certain senses. People would consider this to be a transgression of democratic rights. So this has to be discussed, obviously. But on the other hand, political interference can lead to problems that are not in the interest of the country. Now, I'm not a big fan of number 3, but this is the official EU policy, which is to try to push some sort of debt break into place. I think this is you're tying the last hand that you have. I mean, you have fiscal policy. If you're not highly indebted, you have fiscal policy as a way to react to crises, and it seems crazy to bind these, but I think at least publishing information and giving each other information and maybe letting financial markets rate countries on the basis of a potential default would be a great discipline. We wouldn't have to have balanced budget rules, okay? Because if you borrow money to build a bridge, that's an investment. It's not spending on civil servants' salaries. And you see there's more cooperation in the European semester system. You have this consultations, these consultations that take place on an annual basis. And you have attention being focused on macroeconomic imbalances. So it looks a lot like the IMF, the International Monetary Fund's behavior in the 1950s and 60s. The Bretton Woods system, as you know, was based on gold, at least in a fictional way. But the dollar was the standard. And when countries ran balance of payments deficits for a long time, the IMF would come and say, hey, you got to stop this. Otherwise, you're going to have to devalue. And they were the boss, right? So they even made Britain and Italy in the 1960s do stuff that Greece is doing right now, go into a program, okay? So when you have a fixed exchange rate regime that's so fixed like this, you probably have to have some sort of enforcement mechanism, but this clashes with the goal of sovereignty. So everyone has to look into their hearts and ask, how much sovereignty am I going to give up to have the euro, to have a strong banking system and the rest? So this is a list of the various financial market aspects that have been developed or reforms that have been pushed. European banking supervision is perhaps too multifarious now. The European Banking Authority is supplemented by these 2 others. They're based in different countries, and there's a stability risk board that looks at macroprudential risks, and they report. There's the reform of Basel, which I'm not going to count on. The banking union since 2014, which has 4 important mechanisms. One is the supervisory mechanism. The other is the bank recovery resolution bail-in type of mechanism. So it won't just be bailout; it'll be bail-in at the national level, and that's a very important change. So it's very difficult for an investor now to have complete certainty when you invest in other banks that the government will bail you out. In fact, it's clearly going to be bailed in. You're going to have to contribute as well, so you better pay attention to the banks that you put your money in. If you're a wealthy investor, the resolution mechanism, the SRM, and the recapitalization instrument, which I am skeptical to see how this works in the case of Greece if we have a full-fledged failure, but it will be used. Finally, let's think about monetary policy. So we've dodged the bullet in terms of what the ECB has done. The ECB has done so much, and as this truly European, some would say some would criticize as not being completely democratically legitimized, but it certainly has representation of all the countries, certainly overrepresenting those smaller countries compared to their capital keys. Okay, what has the ECB done since the crisis? They did the securities market purchase program. 200 billion in secondary market purchases. It's quite a bit. So that was against the rules, actually. The European Central Bank is not supposed to be financing budgets directly. Purchasing on the secondary markets, you can make the argument it's not quite the same because it's already been touched by other agents. But in effect, it does create space for more debt issue. Then there was the famous ELTRO credits that were given to banks in late 2011 and early 2012. That's also kind of it allowed Southern European banks to 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 gain access to liquidity to a large extent, by national debt and re-nationalize the debt holdings. This has been a big trend in debt holdings away from diversification towards more sort of a national holdings. And this was spurred on by ELTRO, which makes, of course, the banks more vulnerable and more attentive to national trends. And of course, the famous 2012 announcement by Draghi that he would do whatever it takes to save the euro, including open market transactions, meaning buying openly in unlimited, potentially unlimited quantities, open market purchases. This has been protested against, and there's been a court ruling by the Bundesverfassungsgericht. It's also been declared to be okay by the European Court of Justice, so it's kind of an interesting issue, but in the end, the European Central Bank has the writ to maintain the stability of the financial system, and to the extent that that is affected by turbulence in the bond markets and by the inability of monetary policy to do its thing, it seems to be a legitimate function. You're aware that there's a new asset-backed securities and covered bond program that came about almost a year ago, and not much has happened on that, as I understand it, but there has been a lot of quantitative easing. So the quantitative easing program is indefinitely in place. Monthly purchases of 60 billion distributed across the European monetary union's sovereigns up until September 2016. So that's quite a while. Now, of course, they can interrupt the program. If inflation starts to rise, I think there's a good chance that this program will be interrupted. But it's a commitment to do what it takes to give banks more, not just liquidity, but the ability to make loans if they so desire. So here's the picture. You remember the Fed picture I showed you? This is the picture of the ECB's balance sheet. And you can see we're in 2015. Quantitative easing has not done anything yet. People are all getting worked up about it, but you think about the interesting development is the decline of the balance sheet from mid-2012 to 2014. This basically represents banks deleveraging vis-a-vis the ECB, paying back their loans that they had taken out at the ECB to finance their activity. So in a sense, the banks have endogenously contracted the money supply, endogenously contracted credit activity, and this is one reason why Draghi basically came in and said, this can't go on forever. So this is an aggressive attempt to turn the corner. And I think most published analyses of this tend to support the view that it is actually having an effect. And the problem is, will it have too much of an effect? Will it stimulate the economy too much to the point where we have to do something? So again, be aware that these new institutions, the ESM is the one that's going to survive. EFSF was the stopgap. And ESM is taking over, is basically, if you like, a major player in the financial markets and an interface that will also help Greece. Ultimately, I think the bank bailout that we will expect in the next few weeks will be run by the ESM. And they do have the firepower to do that. Okay, and there's some details for you in case you're interested. The good news is that countries like Ireland, Spain, and Portugal have actually completed, successfully exited their programs. All right, so it's not like money's being poured down the drain. This is a fairly effective way of dealing with a crisis. There's still some unfinished work. Obviously, Greece and also Cyprus need to be dealt with. And the euro area, if you think about it, now has a lender of last resort for sovereigns. Okay, even though the ECB is not supposed to do that, the new ESM program is a way of helping European governments, euro governments especially, that are in trouble, member states that are in trouble, to get back on a stable track. So this is an important mechanism. The question is, will it be used in a sensible way, and will will we be able to solve the moral hazard problem, the idea of running large deficits without any view to repaying them? Okay, so I'm almost done. Just want to mention there are a lot of things that have to be done still. So the capital markets have not been unified. It's not clear they have to be, but it would help. It would help European investors. It would help European borrowers get better access to funds if you had a common capital market. But that is, again, another big step towards political integration. You need to have a deposit guarantee scheme. So one of the things that was not dealt with in the European Treaty was deposit insurance, which is a very costly thing. Your money up to a certain amount is guaranteed by the government, your government. But what if you have deposits in other countries? And what if countries have different schemes? Are you going to have arbitrage, people moving more money to those countries where they have more favorable setups? Or will you be actually subsidizing countries that are that have banking systems that are not quite stable? So these are all issues you have to deal with. These will require treaty changes. These changes will require possibly major changes, and I don't see this happening in the near future. So I think overall, we need to kind of step back and try to deepen the integration that we have as opposed to starting new projects. So finally, the last two slides, the course, we've done a lot of stuff. It's been a lot of fun. I've enjoyed it. The first part was real integration. These are the things you really want to pay attention to. Obviously, the mechanisms of integration is quite a bit in there, especially international trade, a lot of interesting concepts. And of course, the second part, the questions of how monetary integration was at some level necessary and welfare improving, but at some extent perhaps not quite appropriate for many parts of Europe, and shouldn't be appropriate until those criteria are met, not just the Mundell criteria, but the other ones that we discussed. And keeping in mind the financial risks and the risks of sovereign instability, it's important to do this work very carefully and do good due diligence as we move forward. Okay, it's been a fun course. I appreciate your attention, and I hope you have a nice study period getting ready for this exam. And if you forgot something, please take a look at the movies. Thank you very much.